You have arrived at the Forex Trading Fundamentals. Trading foreign currencies is a growingly popular investment activity known as Forex trading. You can learn the fundamentals in this video to get started trading Forex successfully. We'll talk about various trading methods, currency pairings, and how crucial risk management is. In order to keep you abreast of the latest developments, we'll also provide you an overview of industry best practices. By the end of this video, you'll have a good understanding of the Forex market and be ready to begin trading. The basics of Forex trading. Buying, selling, and exchanging different currencies for a profit is known as Forex trading. The biggest financial market in the world, sometimes referred to as the Forex or FX market, with a daily turnover of billions of dollars. As they develop in their trading careers, successful Forex traders must grasp the fundamentals as well as the more complex principles. Currency pairings are constantly exchanged while trading foreign exchange. You exchange one money for another while doing so. The currency you buy is the base currency, and the one you sell is the quote currency. For instance, trading in the most widely used currency pair, EUR/USD, signifies selling the US dollar and purchasing the euro. To make a Forex transaction, you must choose the currency pair you want to work with, the quantity of lots or units you want to buy, and the price you want to pay. Learn how leverage works in the Forex market. By using leverage, you may open larger transactions with the money in your trading account. It may be compared to trading on margin, when you open a position using borrowed money rather than your own money. Each Forex broker has a different leverage. When trading foreign currency pairings, the majority of brokers provide 50-to-1 or 100-to-1 leverage. This implies that you can purchase or sell around $50,000 or $100,000 with a $1,000 account balance using 50-to-1 or 100-to-1 leverage, respectively. While this might greatly enhance your earnings, it also raises the possibility of losses, given that it is not a free pass for traders to blindly assume excessive risks. Leverage should be handled carefully. Choose a suitable trading platform and broker. Prior to starting your Forex trading career, selecting the right trading platform is essential. The effectiveness and user-friendliness of the trader's preferred trading platform play a significant role in the trader's performance. Online trading platforms are available in a range of formats, including websites and mobile apps, as well as desktop software packed with several features. Remember that Mac devices cannot be used with web-based Forex platforms. Instead, go for one that supports MacBook connections and market data. The kind of platform you choose is crucial, but so is the broker you choose. Online brokers were established to simplify commercial transactions involving middlemen or clients. Your selected broker will provide you access to financial tools, and customer assistance will assist beginners to the expansive Forex market. It's crucial to keep an eye out for reliable brokers with excellent customer service, transparent charge schedules, and modest spreads. Develop a trading strategy. Success in Forex trading depends on having a strategy in place. Your plan should include both immediate and long-term objectives, along with the measures necessary to get there. Your strategy steps should take into consideration your trading style and the market's time periods. Along with having both short and long-term objectives, your plan should also put a strong emphasis on risk management. You could also wish to include features of volatility and taxes. In addition, your plan should use technical analysis tools including trends, chart patterns, and indicators. Know the major currency pairs. A currency pair in Forex is a combination of the names of two distinct currencies that is used to indicate the exchange rate between them. The most liquid and transparent currency pairings, which are often matched with the US dollar, USD, are the ones that FX traders concentrate on trading. Read news and market analysis. The key to keeping ahead in the Forex market is to be educated by examining market movements and economic news. You must be aware that any changes in the world's geopolitics, society, economy, or other factors may have a significant impact on your transactions and recently acquired Forex assets. Because funds might lose value as a result of rising and falling trends, market-centric research should contain a plan of frequent check-ins. Market analysis is a trustworthy method for determining the risk and reward value of transactions, as well as the ideal time for trading. Analyze your trades. Learning to analyze your transactions is one of the key components to any trader's success. Your trading plans and methods may have limitations and strengths, and you may learn how to better manage your risk and emotions by reviewing past transactions. You may monitor your performance using a profit and loss (P&L) log to assess your transactions. This notebook should be kept up to date on a regular basis to monitor your progress with each transaction, and to include important details like entry/exit pricing and the potential for profits or losses. Along with factors like the quantity of lots and consistency in the studied deals, you need also pay attention to your entire approach. Practice with a demo account. Trading on a trial account is the greatest approach to gain experience and develop your trading skills prior to trading on the actual market. A demo account gives you a true taste of what it's like to trade foreign exchange on the actual market. Your ability to comprehend ideas like trading platforms, different currency pairings, market analysis, entry and exit points, etc. can help you achieve your FX goals with this account. Keep learning and stay up to date. Learning about Forex has no boundaries. There will always be shifting trends and market-affecting variables, so you should keep yourself informed on a frequent basis. You might benefit greatly from having a well-rounded knowledge base that includes geopolitics, economic theory, global politics, technology, and market analysis. Keep your study going, but be careful not to scrutinize data too much. Manage your risk and control your emotions. Two key elements of Forex trading are risk management and emotional restraint. In the Forex market, risk entails opportunity, but the larger the risk, the greater the possibility of loss. In order to successfully manage your risk, you must keep track of how much you are prepared to risk and allocate your personal risk appetite. Trading must be done carefully, with each trader operating under their own set of trading rules and methods while keeping volatility in mind. Controlling your emotions is similarly important for both profitable and unsuccessful investments. It is crucial that traders refrain from making emotionally charged decisions, since trading on the Forex markets may be emotionally taxing owing to the emotional intensity of quick ascents and dips. Trading judgments and methods of thinking will be much enhanced if you can keep your emotions under control. This is it for today's video. What do you think of our video? Let us know in the comment section below. Don't forget to like and subscribe to the Financial Tech channel for more future updates. Thanks for watching.